Hey guys, welcome to my take on the 2026 budget. Came out earlier this week. They've thrown a cat amongst the pigeons, if that's what the saying is. Very confusing. They've made some significant changes which make the lives of accountants hard work. And I struggle to think the Xeros and the MYOBs and the QuickBooks and the guys that create these systems to generate your tax work, they've got some work to do as well. So I want to have a quick run through of some of the key points, the points that are going to affect our clients, and give you my take on them. So as always, we've got the, let me get to it, general advice warning. Please don't run away and make a change to your circumstance based on something I've said. It may not relate to you, so always make sure that you give us a call and discuss your personal situation. So first one, capital gains tax. The 50% discount is being replaced by indexation. What does that mean? Well, up until now, for most people, because it was different prior, when I started as an accountant way back in the early 2000s, you could use indexation, but then they replaced it with the 50% discount. What that means is if you bought an asset and held it for greater than 12 months, only half of the gain was added to your income. So for example, you bought it for $100,000, sold it for $200,000, you made $100,000. If you held it for greater than 12 months, half of that gain, half of that $100,000 doesn't count. The other half, $50,000, added to your taxable income. Well, we're getting rid of that. We're going to index our cost base now. So what that might mean is if you bought that $100,000 asset and this next year CPI, which is the indexation measure, went up by say 3%, they're going to say that your $100,000 asset, when you sold it next year for $200,000, had a cost base of $103,000. So you made $97,000. So you can see how detrimental the replacement of the 50% with the new indexation can be when you may have had to pay tax on 50, which is now $97,000. And they've also brought in this minimum 30% tax. So imagine a scenario where you're a pensioner, retired, the only income you receive is from super and it's tax-free. And you buy some shares for $10,000 and you sell them for $20,000. You make $10,000. Don't worry about the indexation thing for a second. Let's just say your taxable income was $10,000. As a tax-free person, you don't pay any tax till you earn about $24,000, $25,000. But if they've got a minimum of 30% tax, well, on that $10,000, you're going to pay $3,000. So they've really hit us where it hurts in respect of capital gains tax. Some finer details into how do we calculate this? Well, if you had an asset, say you bought it in 2010, just for example, for $100,000, and at the 30th of June next year, 2027, let's say it was worth $1 million. So you made $900,000. You get to calculate the CGT on that portion under the 50%. Okay, so you made $900,000, $450,000 would be added to your tax return. But let's say you hold that asset for another 10 years. Well, you revalue the asset at the 30th of June next year at $1 million, and then that $1 million is indexed. So you're going to have a situation where you've got part CGT discount, part indexation, hence the reason I said I feel for the software providers in having to figure all this out. Exemption for new housing. So they've tried their best to, I don't know what they've tried there actually. That one kind of frustrates me and I don't want to go there. But let's just say if you've purchased a new house, investors in new build properties will be able to choose either the 50% discount or indexation. What's good, and I don't know if you can see it behind my photo there, but I'll tell you anyway, superannuation funds are not effective. So guess what? All of a sudden, if you want to purchase property, maybe self-managed funds are going to become popular because superannuation is not effective. It's already a concessionally taxed environment, so well worth keeping an eye on that one. Negative gearing, another cat, a whole bunch of pigeons thrown in the middle of them all. So if you purchase a property after 7:30 on budget night, which was Tuesday night, then you no longer have access to negative gearing unless you buy a new property. But again, it's a significant change. So the current situation is, and I use numbers as examples, let's say you bought that house as an investment property, you made 40 grand in rent and your expenses was $50,000, which is depreciation and interest and rates and insurance and everything like that. You lost $10,000. your $10,000 came off your income. So your $100,000 income from work was $90,000 after you took the 10 away, and you paid tax on 90 grand. So that's negative gearing. You lost some money there, offset it against your personal income. Now, that can no longer happen. But guess what does happen? The $10,000 loss, it carries forward. So next year, if that property loses $5,000, then you'll carry forward $15,000. Next year, if it was break even at zero, then you've got a carried forward loss of $15,000. If the following year it made $5,000, well, that $5,000 income will eat into the losses until the losses are all disappeared, and then you'll pay it. So you lose out on the cash flow of the tax refund now, but long term, you don't really lose anything. So negative gearing, significant change, but the impact is not too bad. So properties held prior to Tuesday night, negative gearing still exists. Anything purchased now, you get the negative gearing for this year, okay? Because the rules won't come in until 1 July 2027. So if you buy a property this year, negative gearing will come into play, but from 1 July next year, out the window. Discretionary trusts. Trusts are a form of a place to accumulate wealth, protect assets, and hold assets in a tax-effective manner. Not anymore, they're not. The government has now placed a minimum tax of 30% on trust income. So imagine a scenario, myself and Natalie, as an example, I work, I earn money, Natalie looks after the kids, doesn't earn any income. And let's say we've got investments in a trust. Let's just say we've got a $500,000 share portfolio. It'd be nice if we did. That $500,000 share portfolio, let's say it earns $50,000 a year, just say for the example, okay? If I wanted to distribute that income to Natalie, then she would pay tax at her marginal rate of tax because she doesn't work. So the first $20,000 is tax-free, up to 45 at 16%. Well, not anymore. That trust is now going to pay 30% in tax. Makes it very unappealing. Companies pay less tax than that. If I held the shares in Natalie's name personally, she'd pay less tax than that. So there's some workings or unworking to do around assets inside of trust. Little bit of a tax refund coming, $250 per year. Good, bad, I don't know. It's a tax offset. It's not a refund. It just reduces the tax you got to pay. So it kind of is a refund, but it's for working Australians. Apparently there's 13 million working Australians. If everybody gets this, it's a $3.6-ish billion cost. Like it or not, I'm not sure, $250 coming your way. But you're not going to get it until 28, so it's a couple of years away anyway. And then the $1,000 instant deduction. So work-related expenses, I don't know why they do this, but anyway, these people are smarter than me. The current situation is if you bought stationery and postage and bits and bobs, whatever it was, you tell me when we do your tax return, hey, Jace, this is my expenses. Well, now you can just claim $1,000 straight up with no receipts. So that's cool. So that's from 26, 27. So again, it's not this current year, from 1 July 26, which is a month or so away, the following year. So it's still some time off that there's going to be some impact. There was lots of other stuff in this budget, but that's the stuff that's most critical to you, that's most relatable to you. So that's what I've covered at the moment. There is some work that we need to do. If you're concerned about it, you want to know how we need to make adjustments or anything like that to yourself, give us a call, reach out. We're going to be on the front foot, but we need you to be on the front foot as well. So there you have it. Small little 5-minute, which is actually nearly 9, and we'll leave it at that. All right, guys. Thanks a lot.